Welcome. What if I were to tell you that most business owners who do not have a defined and designed estate plan could end up paying anywhere from 40 to 60% of their estate in taxes? I call that the American lost legacy, and it happens all the time. So I'm here today to talk about some strategies that we've been using with our clients in particular situations. And I'd like to go over this with you to help you and to help you have an idea of some of the strategies that are being used today to mitigate taxes, even after the new big beautiful bill. Now remember, this is for educational purposes, so if you have a situation that you have in your estate, then I would certainly seek out counsel and get some advice from them. In this particular case, I'm using something called the Irrevocable Trust Asset Protection Plan. And what we're going to do is we're going to move over $3 million of assets out of our client's estate, minimize the exemption credits, help him pay for the life insurance that he pays $200,000 a year on, and get any appreciation out of his estate for the future. But first, if you like this video and you wish to help us grow, please hit the like button and subscribe. We come out with videos, a couple of videos every month with different ideas to help you plan your estate, save taxes, increase your wealth. And below I have two particular items that you can download. The business guide tool, which is about 117, 120 pages, a bunch of really good stuff. So when you're planning, you could look it up, help you a quick reference. And then I've also put the link to the copy of my book, published book, Unlocking Your Business DNA. And that book is a book I took the strategies of 50 years that I used with business owners, and I put it in that book, and you certainly could learn an awful lot from that. So in our particular case, my client, James and Carol, have built a nice business that's worth $10 million and growing. They have a life insurance policy that costs them $200,000. They'd like to shift the growth of their company to their children, and they want to minimize as much estate tax exposure as they can. Right now they have exposure of over $2 million, and we need to change some of that. And this is their particular goals right now that we've talked about. So in our planning goals, when we sat down with James and Carol, we defined that we had to, one, minimize the estate growth because they're already being taxed over their exemption credit. Two, we want to make sure we have enough life insurance, not in the estate, but life insurance itself and out of the estate to pay for these taxes. The third thing we wanted to do was exclude the death benefit from taxation. And the last thing is we wanted to use the gift exemptions the most efficient way we can, because we know we'll need more in the future. So our strategy using the irrevocable life insurance trust with discounted business interests works something like this. We gifted the business interests of the S corporation to the trust. Because we had minority interest and marketability, we were able to get a discount of about 33%. So consequently, we were able to distribute $3 million of business value to the trust, but only cost us the exemption credit of $2 million, because when you apply these discounts, the value of $3 million becomes $2 million for gift tax purposes. And by doing that, putting the stock into the trust, and having distributions from the company and the trust, we're able to use that money to pay the premiums. So built on that structure, here's the way it worked out. We got a 33% discount on valuations, minority, and marketability. We have zero growth in the estate. All the growth is going to come into the irrevocable life and trust, so it won't be taxed at James and Carol's death. So we also froze what they have today and shifted the future growth in the irrevocable trust, saving a lot of tax money. So let me walk you through the S corporation and how it all worked. We have an S corporation worth $10 million. They gifted $3 million of the stock to the ILET. There was a valuation discount of 33% minority discount and marketability and restrictions. So they only used $2 million of their exemption because that was the value of the stock. So we have a 10% annual return on assets. We distribute 60% of the earnings every year. And we have a life insurance policy that's costing $200,000 a year, again, to fund the existing taxes in the estate. So on a cash flow breakdown, we have $300,000 of earnings associated with the ILET because we have 30% of the stock in the ILET. We have a distribution of 60% of that, or 180. Now you notice down here it's 120 taxes. Well, because it's a grantor trust, the income tax passes through to the grantor, meaning Carol and James. They pay that tax. So the trust is left with $180,000. They don't have to distribute. And they needed $20,000 more for the $200,000. So they gifted their annual exclusion of $20,000. Each of them right now have $19,000 of exemption credit that they could use. We only needed $20,000. If we took a look at it on a diagram, you'll see that we took the stock, made a gift of 30% of the stock to the corporation, of the corporation to the ILET. The ILET made distributions of $180,000. Carol and James gifted $20,000. Consequently, we have $200,000 to pay that premium every year. And because of that, we also moved, as I had mentioned before, all the appreciation of that $3 million out of the future estate tax liability. So, is this the right strategy for you? If you're an advisor or you're a business owner, the things you want to understand is that you want to be an S corporation, a C corporation, an LLC, a family limited partnership. You have income producing property, and you're eligible for minority discounts as a package. Now, the discounts are important because it means the more you can discount a gift, the less you have to use your annual exclusion and your exemption, your estate tax exemption. Self-funding is it's very important to keep in mind that in this particular case, they had $200,000 of premium. And had we not shifted the company, they would have had to make larger gifts and use not only their annual exclusions, but even their exemption credits because of the larger gift. But by shifting the stock into the LLC, they shifted all the future value and they avoided having to make large gifts because they got that minority discount. The income tax is neutral because it's a grantor trust. They would have paid the taxes anyways. But what's really important for the future is it freezes up their current estate. Now, the one big bill is a beautiful bill. It's great. It's fantastic. And they say it's permanent, but I use a pencil when I write in permanent because we have two parties in our country that are totally opposite of how they want to be taxed. So We don't know what the future lies, but I can tell you we have an opportunity of moving things out of the estate now. Take advantage of it. So, if you own a closely held business and you're looking for an estate tax planning and exposure and you need some advice, certainly I would like to have that conversation with you. Just email me at tperrone@necgginc or call me. My contact information is below, and feel free now to get the book that I have there and also the guide. Well, thanks again for listening to me. I really appreciate it. And this next video that I have coming up is really a great video for you to listen to. Got a lot of great ideas on saving taxes, minimizing taxes. And also, if you like this video, hit like, subscribe, we'd appreciate it. And again, below, you got 2 items that you can download immediately, the guide, the business guide, and unlocking your business DNA. And I thank you very much for taking the time. Thank you.